Planning to upgrade your phone in a year, or planning that long pending vacation on mountains, or thinking about repaying that small loan you took to make some repairs at home. You can have n number of goals that needs to be addressed in the short term, but given a short period of time, the question is, can you plan these expenses better? Can you plan them the way you plan for your long-term goals like child's education, your retirement, which are far away? One word answer is yes. Hello and welcome to our channel 5 Minute Finance by ET Money, where we simplify investing and personal finance. This video is going to be all about how to plan your short-term goals, which are say up to 3 years away, by investing. We are going to explore various short-term investment options that can be used to fulfill your near-term goals. But before we begin, let me warn you that short-term investments are not about chasing flashy returns or get-rich-quick investment schemes or risky options like stocks. Those might seem exciting, but they may turn out to be scams, or if it's not a scam, the risky investment choices like stocks may leave you stranded when you need that money the most. The focus here should be on safe, low-risk options that deliver steady growth and help you achieve your goals. So when I say short-term goals, it can either be an emergency, say sudden medical expenses, or a planned expense like payment of advance taxes or upgrading your refrigerator, buying an iPhone, which may be few months away. And then there can be near-term goals like a vacation or down payment for home, which may be few years away, like 1 to 3 years. Now, when you plan to invest, you need to be mindful of the time period you have to fulfill that goal. Not all investment instruments we discuss here are suitable for all types of short-term goals. So the key is to align your goals with the right type of investment product. Let's start with the conventional options. A savings account with a bank or post office is the most convenient option, perfect for immediate needs like parking funds for a short trip or emergencies. While safe and liquid, returns are modest at 2.5 to 4%. Then we have fixed deposits from banks and post office, which are a tried and tested option. For less than 3 years, they offer around 7% returns, making them great for goals like buying a phone or planning a vacation. Next, let's talk about mutual funds. For short-term goals, you may look at debt funds. Now, debt funds invest in debt instruments issued by the government or corporations. Out of 16 debt fund categories, only a few are suitable for short-term investing. Let's start with overnight funds. These funds invest in securities that mature in just one day. They are perfect for ultra short-term goals like a trip in 1-2 months. Or to keep your emergency fund. Overnight funds are the safest of all debt funds and are highly liquid. Currently, the returns range between 6.3% and 7.03% per annum. Now, if your goal is 3 to 6 months away, you may go for liquid funds and ultra short duration funds. Liquid funds invest in instruments that have a maturity of up to 91 days. Ultra short-term funds invest in securities with maturity between 3 and 6 months. Currently, these funds are offering around 7% annualized return and are great for goals like saving for school fees, parking emergency funds, vacation in 6 months, and so on. Then we have low duration funds and money market funds. Low duration funds invest in instruments with maturity between 6 months and 12 months. Money market funds invest in instruments with maturity up to 1 year. They make sense if you are looking at a slightly longer timeline. They are ideal for your goals 1 to 3 years away, like saving for a wedding, purchasing a car in a year or two, and so on. So basically, when it comes to debt funds, the category of fund that invests in instruments with lower maturity is safer than the one investing in securities with longer maturity. Now, before we move on to the next suitable investment option, let's understand how the investment options already discussed in this video so far are taxed. The next investment option offers taxation benefits as compared to all these options. So it becomes important here to look at the taxation part of the investment options discussed so far. So interest income from savings account and fixed deposits in a bank and post office is fully taxable as per the tax rate applicable to you. You can claim a maximum exemption or income up to 10,000 rupees under Section 80TTA in a financial year. Coming to debt funds. So the gains are added to your income and taxed at your slab rate, regardless of how long you invest. This is for investments made after April 1, 2023. The taxation of investments made prior to this date is different. You can ask us the details by commenting in this video in case you want to know. Okay. So gains in debt funds are added to your income and taxed as per your income tax slab. Now there is one more investment option suitable for the short term. It belongs to the hybrid category. So apart from debt funds, the category of funds suitable for short term investing are the arbitrage funds. They belong to the hybrid category of funds. Now what these funds are, or how and where they invest. So understand it in a simple way like this. Arbitrage means taking advantage of difference in price of the same asset in two different markets at the same time. This allows the fund manager to buy at a cheaper price from one market and sell the same in a different market at higher price, resulting in profit. They need to invest at least 65% in equities. But why the risk is lower is because each security is bought and sold at the same time. So there is no risk of staying investing for a long period of time. Now, arbitrage funds are popular as they combine the benefits of debt-like returns with equity-like taxation. So as we know, in case of debt funds, gains are added to your income and taxed as per the slab rate. But in case of equity funds, if you redeem after 12 months, the gains will be taxed at 12.5% if the profits exceed 1.25 lakh in a financial year. And if sold within 12 months of investing, the gains will be taxed at 20%. So for those falling in the higher tax brackets, the arbitrage fund can provide great tax savings. So these were the suitable investment options for your immediate to short-term goals. Any questions are welcome in the comment section. Remember to avoid high-risk investments when your timeline is short. Stick to tried and tested options that align with your specific goals. And do like this video and subscribe to our channel. And we'll see you soon with another insightful video.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.